want to spend just a couple of minutes here setting the tone for kind of what we're hoping to accomplish tonight. So all of you have shared over the last few months, the last years even, questions with us that tend to center around, I think, a very common set of themes. And again, it's not lost on me that this seminar is about you. If I'm standing up here, or Art, Adam standing up here talking over your head, you're probably not getting much out of this. I can do that. I'm happy to tell you how smart I am. You all are really smart people, and I'd much rather have this be something that's meaningful to you. And so my comments are really going to be geared towards what I've heard from you all through the years, what I've heard from you, especially in the last few months, about what you think is important. This is also a good reminder for all of you, if you haven't seen us in the office in a while, we'd love to have you downtown. If that doesn't work for you, I'd love to hop on the phone, a Zoom, whatever it is. So please feel free to reach out and get on our calendars. Most importantly, again, this is an opportunity for us to share some thoughts with you all on kind of where we are in the world, where we are in the economy and the markets. The challenge in our one-on-one meetings, when you're in the office, when we're on the phone, is that I like to focus more on you, right? It's much more important that we're doing what's relevant to you all in the moment. What kind of cash needs do you have? What is on your mind right now? What concerns you? This maybe not the venue for that. Certainly you can raise your hand and yell at all the things you need, but I think the reality is this is our opportunity to put something down on paper that speaks bigger picture to some of the themes that are out there right now and some of the topics. And so that's really the ultimate goal. With that in mind, you're going to see a couple of things and one very important thing that might be a little different than what you've seen here before. There's somebody not up here right now, and I'm sure that's all on all of your minds. Where's Bob? That very fair question. Bob is doing well. Bob is very graciously suggested that it was time for us to take this over, that he's still engaged with the business. He still wants to know how all of you are doing. A day doesn't go by that I talk to Bob where he doesn't ask about one of you all, but know that he's enjoying himself in retirement, just like many of you. And I'm glad that he's had that opportunity, and just as glad that I get to be up here being the one now sharing some of that message with you. I think you'll see some of the same themes. You'll see some of us talking the same way, often some of the same phrases. But again, I think you're going to see some differences as well, and I'm happy to kind of engage with you on what those look like. One other change. Go back to that very first slide. Okay, at first glance, some new colors, some blues and some golds up there, some stuff maybe you didn't see before, a little bit of a new image. The one thing that really hasn't changed is the name. We're still the same place. We still do the same thing. We still have the same beliefs. What's really important to me is that as we change, we continue to honor what has been. And so you're not seeing name change. You're not seeing drastic changes in terms of thought. It's just, how do we keep things fresh? How do we keep things forward-looking? And so, yeah, I might be the younger face up here. I might be the one that's saying things a little different than what you've heard before. My goal is absolutely to continue to give you the same important messages that you've heard for many years. With that, maybe time to kick this off. So maybe despite what you hear, despite what you read, despite what you see, this economy here in the U.S. is more or less back to the pre-COVID growth. It's slow growth. It is not an economy that is extremely hot. Likewise, it's not an economy that's extremely cold. And really the key here is that the consumer is incredibly strong. You all see it every day. You go to the golf course, you go to the grocery store, you go to take a trip, there's no shortage of people doing the same thing. And so if we're spending money, and I'm going to hit on this theme quite a bit, but if we're spending money, we're supporting the economy. Two-thirds, a little more than two-thirds of the U.S. economy, driven by consumer spending. What matters most importantly is, can we afford to spend money? The thing that has been the challenge, we've seen inflation running a little hot. we've seen inflation at one point in time that was more than a little hot. You go back to June of 22, I think it's probably fair to say that was way too hot. It was short-lived, and for the most part, inflation is back under control, if not right back to that 2% target. Globally, a little bit of a different story. You look around the world and see a number of challenges, not the least of which war, not the least of which slowing economic growth in China. We'll touch on that as well. But know that the goal here is, where are the opportunities, where are the risks? All right, the U.S. economy. I want to be really careful about how we phrase this. I think there was a tendency early in the pandemic to hope, to think that there would be some return to normal. Nothing about this economy is normal, at least not pre-COVID normal. This is a post-COVID economy. Okay, what's that mean? Well, in many ways, the things that we counted on, the things that we looked at before COVID, they've shifted. Not temporary shifts as we initially thought, but some pretty meaningful and permanent shifts. One pretty obvious example, office space. City of Milwaukee, commercial real estate now at about 20% vacancy. We've gotten so far as to say old buildings like the M&I Bank building downtown, probably going to be converted to residential space, to multifamily units. 100 East Wisconsin, just down the road from our 411 building, approved for sale, going to be converted to multifamily residential. Really important thing in that we need housing. We don't necessarily need the commercial space we needed before because fewer people now work in the office. So again, we're talking about an economy that looks very different than it used to. All right, so if the economy looks different, if we're coming down from a pretty hot inflationary environment, the logical question is, how far down do we come? Can the Fed negotiate what we call the soft landing, or are we in for a recession? Are we in for that rough stretch that so many fear? So far, and again, so far, soft landing mostly intact. In fact, I'd argue we really haven't seen the landing just yet. U.S. economic growth has not stagnated the way many people thought. We'll touch on that. And most importantly, while inflation isn't back to 2, it also isn't 8 or 9 like it was. All right, here's one that we're going to get out of the way early. Politics drives uncertainty. There's no two ways about it. It does not, however, drive our economy or the markets. We are in a season in which the goal is to convince you that your vote is going to change the economy. What changes the economy is your spending. You all know this to be true. Regardless of who's in office, you spend money. Regardless of who's in office, I spend money. I have 4 kids at home. Many of you have heard me say it that way a variety of ways a number of times. I'm going to spend money regardless of who my politicians are. And so we'll touch a little bit on what the history looks like. I certainly have gotten that question, and it's fair. It drives uncertainty. Uncertainty creates problems for investors, but long-term it creates opportunity. All right, so here you go. Here's an example of what post-COVID economy looks like. We saw 1,000-foot lumber go from $400 per 1,000 foot to $1,600 per 1,000 foot in the midst of the pandemic. What happened is, in a normal recessionary environment, lumber producers go, hey, nobody's going to build homes, nobody's going to finish their basements, nobody's going to put pergolas in the backyard, we're going to shut down production. But with COVID, something really weird happened. None of us were allowed to leave the house. We all decided we need more space. We need more usable area within our home. I need a place to teach my kids from home. I need a place to work from home. We spent money on home improvements like it was nobody's business, at the same time that lumber producers weren't producing. So you saw this massive spike in lumber prices. Today, 1,000 board foot lumber is about $500. So we're almost back to where we were pre-COVID, a little bit elevated, 25% elevated. But again, we have transitioned from an environment in which COVID caused this massive disruption to an environment in which, oh, okay, we're a little bit more back to what it should look like going forward. Up on the screen here, this is TSA checkpoint traffic. Exactly what you think it is. This is people going through airports. We basically shut down airports overnight. No wonder no one was traveling. There was nowhere to go. There was no way to get there. Airlines literally transitioned from moving people to moving packages because it's the only way they could keep some of their pilots in the air, continue to pay the leases on the planes they had. And so we had this environment in which, okay, all of a sudden we're shut down. All of a sudden we don't have the opportunities we had before. I want to be clear, we are now back, as of this summer, to pre-COVID levels. We actually have the 10 highest days in TSA history in the last 6 months. And so when you look at the environment in which consumers are spending, we're back to spending on travel the way we were prior to COVID. And in some places, maybe a little bit more. All right, so if lumber and air travel are the kind of polar opposites of what happened in the pandemic, potentially we have some other things we might think of that are parts of that problem as well. The good news is that gross domestic product, again, the kind of big picture look at our economy, value all the things, all the output of our economic engine, and put a number to it. Gross domestic product, right back to where it was, right back on that pre-COVID path. And of course, pre-COVID, the economy was growing at a little bit better than a 2% rate. Right now, thinking is maybe 2024 we hit 2.5%. When you look at Federal Reserve forecasts, central tendency on the Fed's dot plot, something like 2.1% over the next couple of years. Not terribly hot, not terribly high rates of growth, but certainly a pretty happy place to be because it's not negative. And so if we transition to the last part of this, this is S&P 500 returns under different administrations. It's a data point that I think is almost useless in a 4-year stretch, incredibly useful over really long periods of time. If I've told you that the economy is doing well, if I've told you that the consumer is strong, if I've told you that the economic engine is consumption, well, okay, what's going to disrupt that? Potentially politics, but if you look at almost 100 years now of market history for the S&P 500, you had Republicans in control, complete control, for 13 of those years. You had Democrats in complete control for 36 of those years. Complete control being presidency, House, Senate. Average return under Republicans, 14.5%. Average return under Democrats, 14%. In either case, you're making really good money investing in stocks. It isn't about the politicians. It is. Don't get me wrong. Politics matters. But ultimately, free market, the ability to invest in businesses with great ideas, is what drives our ability to get gains long term. And so, yeah, you can look at those other two numbers and go, hey, there's some pretty big divergence there. I'd urge you to look at those two on the left, and then remember that that one in the middle for split government with Republican president, it includes a couple of really bad stretches that really had very little to do with that presidency and a lot more to do with, I would argue, some pretty significant policy failures. Look at the financial crisis. We had some pretty significant policy failures, not just directly leading into it, but for years leading up to it. And so it is clear in the data, it's clear in how we measure the economy that politics matters. What's more clear is that there's opportunity for investors to make money regardless. All right, so let's talk about the consumer for a second. Real inflation-adjusted wage growth is emerging. When I say real, what I mean is I'm not strictly looking at the numbers getting bigger because of inflation. I'm looking at the fact that adjusted for inflation, households are making more money. The challenge is, as we've seen a bit of a divergence in consumer confidence, consumers have gotten a lot pickier about where they want to spend money. And so you're starting to see that in a lot of areas, really in particular at some of the lower income levels. The good news, a lot of you in this room, especially a lot of the folks we have joining us for the morning seminar, have joined what we're calling the Great Retirement Wave. The wonderful thing about retirees, you know pretty much down to the penny what your income's going to look like, and you know pretty much down to the penny what your spending's going to look like. My grandfather was a retired Lutheran pastor. He used to tell me, yeah, I'm on a fixed income and it's fixed too low. I'm sure that probably resonates with some of you. The good news is you have Social Security. Some of you, most probably don't anymore, but some of you have pensions. You have your retirement savings, your IRAs, your taxable accounts. Two of those buckets, Social Security, gone up pretty meaningfully with cost of living adjustments. Your retirement savings, probably gone up pretty meaningfully with the markets. If they haven't, maybe that's a conversation we need to have. But my suggestion is that if we have more folks, and we'll talk about this, but if we have more folks entering that retirement window, their spending is already pretty well established. There's now a backdrop for the most important part of our economy that hasn't been there for many, many years. You know what you're going to spend as a retiree. You know how you're going to spend it. Of course, as we have gone out of our way to slow the economy, to get inflation under control, we have, arguably intentionally, slowed the labor market as well. If those that are working are the other piece of the puzzle in consumer spending, we need to make sure that we haven't gone too far. Jay Powell of the Federal Reserve, Chair of the Federal Reserve, said yesterday they're going to continue to be very diligent in the way that they navigate those issues. The goal is get inflation back to 2. That's the mission. That's what they're saying publicly. I think in reality, the Federal Reserve is much more willing to accept inflation at 2.5% or 3% if it means that unemployment stays relatively low, if it means that the labor market itself remains relatively strong. And of course, as I said, if consumption is the key to the economic engine, well, the car seems to be in pretty good shape. We've changed the oil. We've gone through all the necessary steps to make sure we can get it out on the track, and now we just need to let it run. All right, so here's your real median household income. Back in 2019, we peaked out at $81,200 in real median household income. Again, as of the end of 2023, almost back to that pre-COVID peak. We're now at $80,600. Households absolutely have more money to spend. As importantly, and this is a question I get quite often, well, aren't we seeing some issues on the debt side of consumer balance sheets? In areas. Okay, so credit card delinquencies, 30 days past due, auto loan delinquencies, 30 days past due, have started to creep up a little bit. They are still at or below pre-COVID peaks. Those pre-COVID peaks are well below any level we saw in the years leading into the Great Recession, a pretty rough period overall for delinquencies, and certainly well within the norms of historical averages. Just as obviously, you look at the left-hand side, the darker line on your chart here, household net worth. Okay, household net worth has never been higher, in part because one of the biggest assets on a household's balance sheet, the house itself, has gone up substantially in value. We're going to talk about that a bit when we talk about inflation. But know that it's really tough to just instantly tap into the value of that home. On the other hand, you're not buying homes all that often, so you don't always feel that impact. It does make us feel wealthier to get the assessment from the I just got my assessment in the mail over the weekend. I'm sure many of you have seen a similar letter recently, up substantially. Nothing I did to the house, it's that everything in the area has been priced higher. And so we feel a little wealthier. Yeah, I'm going to maybe owe a little more in property tax, but I feel a little wealthier because my house is worth a little more. Again, the other side of that, household debt service. Yeah, we've come back to pre-COVID levels after debt service tailed off a little bit amid the pandemic. But really, households are not having an issue servicing that debt. All right, here's a new one, and potentially one of my favorites. Because it speaks to a lot of you in this room. So, workers retired and receiving Social Security benefits eclipsed 50 million people for the first time in 2023. In 2023, we added 1.56 million new retired workers receiving Social Security benefits. As importantly, According to Empower Research, 4.1 million Americans are going to turn age 65 this year. This is the year in which the vast majority of our working population starts to shift towards that retired generation. Now, of course, depending on what study you look at, most workers believe they're going to make it to 65. The reality is most retire at 62. And so some of the conversation that we have is, how do we bridge the gap? Some of the conversation that we have is, what does it look like? But if I'm telling you that retirees on Social Security know how they're going to spend, they know where that money's going, they know where it's coming from, and more people enter that phase of life, no wonder that I have some confidence about our economic engine. I know how that money's going to be spent. Now, you can rightfully ask, what happens in 10 years when we reach the tipping point, right? When we no longer can afford all the benefits we're paying out. It's a political question, it's fair. There isn't a great, easy answer to that problem that magically says, oh, everything's going to be fine. There's a lot of really simple steps you could take. I know that is a question that's on your minds. Is Social Security still going to be there for me? We think on average, the Government Accountability Office thinks on average that Social Security benefits are about 85% funded when we get to that point. And so a lot of ways we can solve that problem. But broadly speaking, your spending's not disappearing overnight. All right, here's the unemployment rate, a really simple slide. I don't need to belabor the point here other than to say we now sit at a 4.2% unemployment rate in our country. Workers are making more money, more of them retiring. We have more job openings. We have fewer people leaving their existing jobs. Overall, the labor market remains quite strong. And so if the Fed's goal is get inflation under control, it's no wonder that they were able to cut rates. If the Fed's goal is make sure the labor market is okay, it's no wonder that they were worried what happens if we don't. All right, here's inflation. 2022, the year in which I think most of us thought, hey, it's going to be tough to get this number back under control. It crept up on us far more quickly than what most anticipated. Inflation, and I'll talk specifics here in a minute, but inflation came about quite quickly, and it was pretty painful to get rid of. Most of you saw that in the bond piece of your portfolio. The good news is that we've gotten that meaningful but temporary high spike under control, and now inflation continues to trend lower. The problem, and this is a question again that I hear, the problem is that lower inflation doesn't mean lower prices. Inflation simply measures the rate in change of prices. Once they've gone up, the only way you get them back down is through deflation. Deflation is a pretty dangerous thing for an economy. You enter what's called a deflationary spiral. I'm very much hoping that's not a world we enter. It doesn't appear to be the case. Japan's flirted with it a number of times over the years. We've seen parts of the European Union flirting with it. But right now, not the problem. Most importantly, how we measure inflation actually matters. There are a variety of tools that the Federal Reserve looks at. They have a preferred measure, but they look more broadly at other indicators. We'll talk a little bit about why maybe there's some strategy to make sure that we're not being taken advantage of in what is presented to us, because it's pretty easy to tell a story that's different than maybe what's more broadly going on. All right, so here's headline consumer price index. I'm very intentionally picking this headline CPI number. Could just as easily pick core, could just as easily pick personal consumption expenditures, could just as easily tell you, hey, let's only look at food and energy. None of that really tells the whole story. Headline is all prices out there. So inflation spiked at about 9% in June of 2022. At the time, the labor market was red hot. Unemployment hit its lowest level in 50 years in early 2023. And the hope was that by raising rates, the Fed could cool inflation without, again, causing unemployment to spike. Remember, the Fed has a dual mandate. Their job, control inflation, price stability, while maintaining stable employment. Of course, those two things sometimes are mutually exclusive. So far hasn't been the problem. There have been 16 episodes of central bank increases across the US, Canada, Germany, and the UK since 1950. Depending on who you ask, in every one of the cases in which a central bank raised rates to combat that period of high inflation, that central bank caused a recession. I have a pretty significant suspicion that we may have discounted a couple of periods in that. That study, by the way, done by a number of central bank economists around the world. 1994, many of you remember, probably the perfect example. Alan Greenspan coordinated what I think is probably the playbook for fighting inflation. We rose rates quite quickly early on. We slowed the pace of those rate increases, and then as soon as it was necessary, we started to cut rates again. Inflation largely got under control quickly. We avoided the typical tailspin that came from that period of rate increase. Of course, what's happening now? The Federal Reserve raised rates very quickly early on, and now that we've reached a point where inflation is moderated, we're starting to cut back. We're starting to stimulate again. Of course, rates remain fairly restrictive, but removing some of that restriction. All right, here's the problem, and it is a pretty meaningful problem. I can tell you all that it's raining outside right now. Doors are all closed, there's no windows. Okay, maybe you could hear it on the ceiling, but in this room I can tell you anything that's going on out there, what I say goes. I probably know I'm up here standing at the podium. Journalists can pick an inflation data point and tell you, hey, this is what inflation is. This is what you should care about. Okay, what data point did they pick? What are they looking at? Because I can tell you that if I look at consumer price index for all items for urban consumers, June of 2022, that rate of inflation was 8.99%. As of August 2024, it's 2.59. When I tell you that inflation has come down significantly, that's what I mean. I could tell you that food inflation, going back to June of 22, was 10.44%, and it's now 2.06. Or I could do what a lot of people say and go, well, yeah, but if you only look at this one data point, inflation is not a problem, or inflation is a problem. Energy, the perfect example. 40% inflation going back to June 22, now a negative number, negative contributor, net detractor to the rate of inflation. So if I can tell you any story I want about consumer price index or inflation more broadly, how do you defend yourself against somebody that wants to tell you, yeah, inflation's 3.3, not 2.6? Pick a number and stick to it. The Federal Reserve, for their part, has an indicator that they look at. Yeah, they're going to look at a lot of different pieces. They have to. It's their job. But they look at personal consumption expenditure. I'm picking CPI. I could just as easily pick a different number. But when you start to get into, okay, what happens if? What happens if all I do is look at this number? You start to get a better idea of what the actual direction is, not just what someone's painting a picture of today. All right, I've spent a lot of time talking about the U.S. economy. I think we'd be remiss if we didn't mention that there's a lot of other areas of the world worth touching on right now. Let's start with the Eurozone. Europe has been in a period of pretty profound stagnation for really the last 15 years. Post-financial crisis, Europe really didn't recover the way that the U.S. in particular did, but some of the other parts of the world as well. A couple of exceptions. We saw a pretty meaningful spending boost in Europe this summer that helped the travel industry, the services sector, even as manufacturing in Europe took a pretty big step back. So some of you may know Taylor Swift toured in Europe this summer. Probably a few people went and saw that. We also had a pretty big event in the Olympics in Paris. Also had a lot of people, go back to my slide on TSA traveler traffic, a lot of people that re-entered that travel environment for the first time last year or this year. There was a lot of pent-up demand for those European vacations. And so not really a surprise to me that we've seen a bit of a spike in tourism, in service sector spending in Europe. I think maybe we're getting a little overly optimistic if we say that that's the long-term trend, and especially when you look at some of the manufacturing economies. Germany is a great example, being a little bit weaker right now. The bigger concern to me is China. You'll understand the humor here in a second, but I'm saying this at a time in which China may actually be doing something right, but more broadly speaking, China continues to struggle pretty drastically. And most importantly, global growth really continues to be tied to the U.S. economic engine. It used to be said that if the U.S. sneezed, the rest of the world caught a cold. One of the big reasons for that, the U.S. economy not particularly export-driven. The rest of the world, in particular China, Germany, very much export-driven. We put a slide up in 2019, some of you may remember it. It said at the time the U.S. economy was 12% exports. U.S. GDP was 12% exports. China, almost 20%. Germany, close to 50%. And so when I tell you the German economy is much more reliant on the rest of the world than the U.S. in particular, it's because so much of what they do leaves Germany and comes here or some other place in the world. Of course, the U.S. has become even less export-driven. The rest of the world, it really hasn't shifted all that much. And so really global growth continues to be tied quite heavily to the U.S. economy. All right. The irony is not lost on me that we're discussing China's struggles after they had the best week in 15 years last week. If you believe the data coming out of the People's Bank of China, I understand there are reasons to question that, but if you believe that data, the Chinese economy is growing at around a 5% rate the last 2 years. Going back to 2022, the Chinese economy had slowed to about 3%. I think the data, looking back, a little easier to believe than in the moment, but even still, 3%, 5%, it's a far cry from the 7 or 8% growth that we saw in the mid-teens for China. China has a problem. They are transitioning from an economy that was driven very much by spending government money. Invest government assets in building new roads, in building new cities, and the money will follow. The economy will grow because it becomes more efficient to move goods and services. The problem, of course, is that eventually you build roads to nowhere and apartment buildings that no one is living in. And China had a pretty immense property crisis over the last few years. So what we have seen, as of last week, the Chinese central bank decided, hey, this is a problem that requires somewhere between 140 and $280 billion to try to stimulate the Chinese economy. Of course, what they're doing is a thing that we did and maybe making risk-taking a little too cheap. Throwing money at businesses that want to buy back their stock. Throwing money at stock purchasers that might want to borrow money to buy stock. Lowering mortgage rates. And so China has stepped in, and the market responded by having some pretty significant stock gains, but China has stepped in and said, hey, let's stimulate our economy. That works to a point, but eventually, the economy needs to be supported by consumption. It needs to be supported by the underlying people in the country driving the economic engine, as it has here. The only way you emerge as an advanced economy, at least from what I know from my teaching, the only way you emerge as an economy into an advanced status is to transition from an investment-driven economy, driven by government spending, to an economy in which the consumer is the thing that drives. U.S. stock market. So we talked about the economy broadly. U.S., pretty strong, pretty good shape. Some reasons to think that maybe things can be a little better. Globally, some questions. And so let's talk about stocks here in the U.S. The biggest driver of stock returns the last 2 years, and it has been an exceptional 2 years, megatrends. Artificial intelligence, automation, robotics, to a lesser extent, but still meaningful, healthcare innovation and adoption. So consider that in the last 2 years, we had a massive auto union workers strike. We had a Writers and Screen Actors Guild strike. We had a actors strike. We had now, as of today, a strike at the port on the East Coast and Gulf Coast. one of the common threads amongst all of that labor distress, the role that artificial intelligence and automation are going to play in our lives, our work lives going forwards. One of the big sticking points for the auto union, they wanted 4-day work weeks. If the thinking is that 20% of the auto union workers are going to be out of a job because robotics and automation take over, what's one way to preserve your workforce that otherwise would be cut by 20%? Cut 20% of your working hours. Now you got a 4-day work week. People are getting paid the same amount. All right. Same deal for one of my favorites. Many of you have probably heard this one. You stop at McDonald's on your way home. No judgment. Certainly better food choices out there. But you want to stop at McDonald's on your way home. Odds are there's not somebody standing at the register ready to take your order. Odds are you're plugging your order into your phone, or you're going into the restaurant, plugging it into the kiosk. So the thinking was that pre-COVID, we would be losing jobs in the restaurant, fast casual industry at a pretty meaningful clip once more and more firms adopted this. The reality is, post-COVID, we've seen about 15,000 jobs added to that part of the universe, because what happens in these transitions is not that people are out of work, it's that they're repurposed to higher functions, right? You're moving from the register to packing orders because you can get more orders through. Productivity gains are pretty massive when it comes to technological innovation. All right, so the challenge is that the last 2 years, that innovation drove some pretty strong returns in growth stocks. Most recently, the last 3 months or so, we've seen a much more significant broadening in the rally. And I would argue, supported by earnings, not just what we've seen so far, but also what we expect going forwards. The challenge, of course, is that stocks are no longer cheap. I think most of you know that, most of you see that, most of you have heard that, but valuations can be a problem. All right, so here we go. Here's total returns for the Russell 1000 Value and the Russell 1000 Growth Index. Really high-level value stocks, things like utilities, energy, some of the older banks, things that don't grow really fast, but that you tend to buy at a pretty good price. Maybe they pay a dividend, maybe they don't, but they tend to be cheap. The growth stocks, on the other hand, the things that have all of the stuff we were talking about earlier, the potential for productivity gain, the potential for all that technological innovation, whether it's the healthcare, the technology stocks of the world. The challenge, of course, is that if you got to pay too much for growth, it might not be worth it. And that is maybe what we've seen a little bit of the last quarter or so, value stocks in the quarter, well, up till September 25th. So I don't quite have data through yesterday's close, but up through September 25th, value stocks had grown 8% on the quarter. Growth stocks had only grown 3%. And what I think is an interesting transition, when you consider that a lot of those value stocks may not be early adopters of some of the technology we're talking about, but they're going to adopt it eventually. They're going to be forced to. And so if, as McDonald's, you can get more orders packaged more quickly because your workers don't have to focus on the cash register, now they can focus on packing those orders. Or if, as a longshore worker, you now don't have to focus on checking in the truck or moving that massive container because it can all be done automatically. Now you can focus on some higher order good. Now you can move more product through your port. Well, all of a sudden, you've got a way to make more money. And if the value stocks see that, they're going to want some of it too. They don't have any issues piling on. And so I think what we're starting to see is that some of those more traditional value names starting to see the benefits of the automation, the artificial intelligence. It's a scary thought. All right, here's the key to all of this. Stocks are driven by two things. You've heard this one 1,000 times, earnings and interest rates. Earnings growth, not all that great coming through the pandemic. We had a 4.8% rate of growth from 21 to 22. We think about 1.5% going into 2023. All of a sudden, though, this year, pretty strong earnings growth, almost 10%. We look into the future, forecasts right now for 15%, maybe 12.5% the following year, driven by those mega trends that I'm talking about. Here's the deal. When you look at what specifically drives our desire to pay for stocks, it's the potential for them to make more money down the road. You as an investor are buying an interest in that business. You're buying an interest in its revenue, its earnings. If that company can make more money because they're more productive, well, that's more money to you as an investor. And so that growth number becomes critical to the long-term viability of markets. It becomes critical to your long-term viability as an investor. The challenge, and it is a challenge right now, is that we have to pay up for those earnings. A couple of reasons why I think that's warranted. I am going to go out on a limb here and suggest that this may be a new roaring 20s. I am as optimistic about the path forward for stocks as I've been in a very long time. The prospects for significant improvements in productivity are coming at a time in which we don't have the workforce we once had. We have no choice but to innovate. We have no choice but to become more productive. If that productivity gain drives profitability, if it drives earnings, well, I'm willing to pay for it. As importantly, the composition of the S&P 500 looks nothing like it did 15 years ago. So when I tell you that the average forward price to earnings ratio on the S&P 500 is 16.7 times forward earnings going back to 2004. Yeah, great. I'm not sure there's all that much value in that historical number when it's tied to a universe that no longer exists. We are in a post-COVID world. Again, some of it we were forced into. Never thought I'd do the number of Zoom meetings I do. I don't mind seeing all of your faces on camera. Again, much rather see in the office, much rather see in person. But the reality is I can do far more things than I ever could before because of those technological changes. All right, I'm going to point out a conversation that I had on this very stage last year. So talked at length about John Deere and the role that technology plays for a company that makes farm implements. Go back to the 1930s. And again, some of you have heard this, forgive me. Go back to the 1930s, we had 6.8 million farms in our country. 6.8 million. Around 1926, numbers are a little fuzzy here, but around 1926, something like 20 to 25% of our population lived on a farm. Okay, so what happened in 1892 that might have started that transition? A small town in Iowa, we created the first gasoline-powered, wasn't called a tractor at the time, but basically what the modern version of a tractor is. 1930s, we became far more productive in the way that we cultivated crop. We started cross-pollinating corn, for example, to get much higher yields. What happened is, in addition to more opportunity being available in urban environments for farm workers, we became far more productive at the way we farmed. And so you had this transition of workers who were sometimes pushed out of farm jobs, pushed into the city to go work on a factory line, but at the same time, we created these massive new opportunities. It is a scary world, especially if you are a Hollywood writer looking at a piece of artificial intelligence that can basically write your Hallmark movie script as well as you can. It is a scary world if you are a truck driver looking at the prospects of a self-driving truck that can move a container from one side of a port yard to another. It doesn't mean there isn't work for you. It means that what that work looks like is going to shift. And so when I tell you that I am incredibly optimistic about what the next 15, 20 years look like, I am incredibly optimistic because of the opportunity. I'm incredibly optimistic because of what it means for the growth of earnings in the businesses that we invest in. Not just the growth names, not just the semiconductor manufacturers and the cloud computing companies and the software companies, but all the companies that are going to get to implement that technology. Now, don't get me wrong. Your information is the last piece of information I'm going to be plugging into artificial intelligence anytime soon. I take what we do for you far too seriously to just willy-nilly say, hey, tell me how to invest this portfolio, or tell me what I should know about these people. But elements of artificial intelligence, automation, are going to make their way even into what I do. It's a scary prospect for me. The reality is, I'm going to be at this for a long time, but the reality is it won't be me that solves that problem. My children, your grandchildren, maybe your great-grandchildren, are going to be the ones that figure it out. Here's the real challenge. I can't tell you what's going to happen tomorrow. Odds are, we're going to see some volatility between now and then. And so when we talk about how we invest, understand that there's a portion of your portfolio you're not thinking about for the next 5 or 10 years. You can't. Because what you're hoping for, what I'm hoping for, is the kind of technological optimist, is what I know is coming. What I need to do to get there is not take too much risk. One of my favorites. This is the S&P 500 earnings yield versus the 10-year Treasury. All right, so earnings yield, simple as it sounds, put $1 in the S&P 500, how much earnings, what's the yield on that dollar that you get for every dollar you invest? Simply the reciprocal of the price to earnings ratio. 10-year Treasury, pretty typical benchmark interest rate. You want to keep money safe for the next 10 years. And again, some of you may challenge this notion, but park it with the U.S. government. You'll get it back 10 years from now. You'll get it back with, right now, about 3.7% interest. You know what you're getting. If I can get more in $1 invested in the S&P, earnings yield, than I can $1 invested in a 10-year Treasury, what's it worth to me? I'll tell you historically, you go back on that slide to, say, 2008. You have this massive divergence between the earnings yield, that kind of dashed dark line, and what you could get on safe money. I absolutely wanted to take risk. Made all the sense in the world. I'm getting paid to take it. Why wouldn't I? Right now, the math's not quite so simple. You actually get a pretty reasonable rate of return on safe money. So for everything I'm telling you about how optimistic I am about the future for stocks, understand that I'm telling it to you in an environment in which, yeah, you don't get paid quite as much today to take that risk. Of course, the challenge is, it is a bigger number. 4.3% earnings yield right now, 3.7% on the 10-year Treasury. I know who taught me how to do that math, but 4.3 is a bigger number than 3.7. All right, let's talk about bonds for a second. We stood up here last year. We stood up here in 2019. We stood up here in 2013 or 14 talking about a yield curve inversion. A point in time in which really short-term rates, things like cash, pay you more than interest rates on longer-dated bonds. It's a really unhealthy place to be long-term. It tends to signal a likely recession because investors are betting that growth's going to slow. They're investing that there are problems out there that are going to cause rates on the short end to have to come down eventually. The problem, of course, is that we've been in an inverted environment for quite some time. That recession hasn't come. Doesn't mean it can't. Again, I'm going to stand up here and tell you that about half the time we see it coming. About the other half, nothing that you're going to predict is going to tell you, hey, today's the day. But I am here to tell you that the inverted yield curve, not the thing that's telling me, hey, the recession is on its way. In fact, what the real reason for the inverted yield curve is, the Federal Reserve is the only thing that controls short rates. If the Federal Reserve is intentionally trying to slow growth, okay, well, longer rates should be lower. At the same time, if the Federal Reserve is keeping those rates on the short end high, what you get is something that looks like this. The left-hand side of that chart, you have those really short-term rates, the overnight lending rate, what the Federal Reserve actually controls, that, again, are far, far higher than anything you're going to get for much longer lending. All right, one other challenge in the bond market right now. There are areas of the bond market that start to look attractive if the Federal Reserve cuts rates. There's areas of the bond market in which you're going to get paid 400 basis points, 3 percentage points, 4 percentage points more than what a Treasury pays. Okay, so if I'm telling you you can get 3.7 in a 10-year Treasury, all of you would much rather have 7 or 8, right? It's a bigger number. Would love 7 or 8. The challenge is to do that, I got to take a lot more risk. How do I value my desire to put up with that volatility? I want to be paid for that risk. Right now, you're not really getting paid for that. In fact, you're probably getting paid more to take that risk in stocks. All right, here's one that I think is going to resonate. End of the year next year, Tax Cuts and Jobs Act is set to expire. I don't know what that means. I mean, I know fundamentally that tax rates are going to go back to where they were prior to the Tax Cuts and Jobs Act. But to date, I haven't seen a great proposal for here's how we're going to extend them or here's what rates should look like going forward. Again, above my pay grade, that's for the politicians to decide. But what I do know is that the most meaningful number for whether or not municipal bonds make sense for all of you is what's the tax impact on investing in municipals. And so for some of you, municipals maybe don't make sense right now. They might make sense again in a year if tax rates go up. The challenge is if they go up, they may not go up for all of you. And so that's an area where we're going to have to be a little more clear as we get more information. Here's what tax policy is going to change to say, okay, does this make sense for you, doesn't it? Last but not least, really high-level thinking here. If I'm getting paid more for bonds, bonds look more appealing. All right, we talked about the yield curve. I want to touch on high yield spreads for just a second. Really simple concept here. High yield spreads, just what you're getting paid to take the additional risk buying high yield, or sometimes referred to as junk bonds. Exactly as it sounds, high yield, higher yielding, with higher risk. If I was getting paid to take that risk, historically the premium's about 5.8% percentage points. If I was getting paid to take that risk, I'd take it. There are narrow windows in history in which you get paid for that risk. Occasionally we dabble, occasionally we'll push a little that way. Generally speaking, I'd much rather own stocks. You're going to get paid a lot more and you're going to have the same volatility. Do not fall for the trap that simply because rates are coming down, 3 is not as good as 4. 3 is just as good because it gives you the safety you need. Talk for just a couple of more minutes here. I want to talk on the global stock market. I gave you all the problems that are out there in the world right now, and there are a lot. We have a trade war that continues to weigh on a number of export-focused countries. Clearly war in Russia and Ukraine. Israel engaging in now war with Iran. Add in some of the other issues that are out there. Conflicts that continue to persist in the South China Sea. I can go on and on. What's not unique is that there are problems in the world. And so if we know that to be true, the bigger question is, all right, can we get a deal? Am I being compensated for the risks that are out there? And am I being smart about the risks I take? So right now, valuations outside the U.S., fairly attractive. And right now, the dollar is fairly strong. A weaker dollar becomes a tailwind for non-U.S. stocks that may make some of that investment attractive. Global valuations, S&P 500, significantly overvalued relative to history, as I mentioned. When you look at the MSCI, ACWI ex-US, the all-country world ex-US index, really more or less right on historical averages. Likewise, we often look to global stocks for dividends because they are generally better dividend payers. We're getting almost a historical average dividend rate from global stocks. Here you've got the dollar index. You can see a pretty meaningful period of strength. It's funny, we had some global investors in the office going back to 2018. They told us at the time, hey, the dollar's about as strong as we should ever expect to see. Non-US investments look great because if you take your dollar, you go buy a European stock, you've got to buy a euro to do it, turn around and sell that stock, even if the stock doesn't make money, as the dollar goes down in value, you're going to be able to come back to the dollar and you'll have more. You've got a tailwind to your return even if the stock itself doesn't do well. The problem, of course, was that not only did the stocks not do terribly well, we also had a dollar that just kept getting stronger because the rest of the world didn't show the kind of growth, the kind of stability that the U.S. showed, especially through the pandemic. All right. All of this, I think, speaks to how we want to invest going forward. Stocks are your long-term option. Yeah, valuations are a bit elevated. We've been here before. High valuations don't simply lead to lower valuations tomorrow. Two things lead to lower valuations, by the way. Price over earnings, price to earnings ratio. So either the price comes down, not the thing I'm hoping for, or earnings pick up. The thing I kind of pointed out earlier, I think, is what's going to happen. And if earnings pick up, valuations naturally start to come back to normal. The challenge, of course, is that we're operating in an environment in which bonds actually look fairly attractive. You, as investors in bonds and bond funds, paid the price for these returns. You paid that price in 2022. All of you know it well from looking at your portfolios. There is a tendency to want to say, well, but if interest rates are coming down, I should be doing something different. Yeah, potentially, but don't give up on those things that are designed for a specific role in your portfolio simply because the return equation has changed. Let's look at risk as well. And the best example I have for you is cash. So the Federal Reserve cut interest rates 50 basis points middle of September here. All of your money markets are going to follow suit pretty quick. They are tied to very short-term paper, very short-term loans that are going to turn over in the span of 90, 180, 270 days at most. So your 4 3/4 or 5% money market rates that you were seeing at your bank or your brokerage account become 4.5, become 4 1/4. And if the Fed keeps going, become 3 3/4, 3.5, 3 1/4. Maybe we stop. Maybe the Fed has to go a little further because the economy slowed too much. All right, so if that's the world we're operating in which cash now pays a little less, does that mean I shouldn't have any cash anymore? Probably not. It's where that final piece of the conversation comes in. I can tell you till I'm blue in the face, here's the right answer for every portfolio. You all know we don't build models. You all know what we do is specific to you. The reason for that is I might think cash is a great idea, but if you don't need it for 20 years, I got a far better opportunity. Likewise, I might have a far better opportunity, but if you need it tomorrow, you probably need some cash. And so don't give up on cash simply because the rate's going down. Yeah, you're not going to make as much in interest. Good news, maybe you have a little bit less of a tax burden than you had before. That's a question I got quite a bit. Hey, I had interest for the first time on my money market account. I owed some tax I wasn't expecting. Yeah, it's one of the drawbacks of higher rates. But remember that cash has a role. Last but not least, so 2016, 2017, 2018, we talked considerably about the role that non-US stocks should play. And I said at the time, hey, I think there's some great opportunities out there. I'd argue every one of those opportunities is still out there 5 or 10 years later. So take it with a grain of salt because while we weren't wrong, it didn't materialize the way we hoped. But if stocks have a tailwind from a potential for a weakening dollar, if non-US stocks have a tailwind from potentially some better valuations, I'd argue that maybe they need to play a little bigger role going forward than what they've played in the past. That isn't to say I'm terribly excited about investing scattershot. I'm not simply going to buy the global index and say, here you go. We've got to be really careful about the risks we take because there's a lot of potential challenge out there. I just want to reiterate that we've put a lot of time and energy with a lot of good partners into the website. Would love, if you haven't checked it out, for you to check it out. We've got a great newsletter we send out every month. Really the goal of this, the newsletter, the podcast, to give you all of the things in a timely fashion that you need to stay up to date on what we're thinking. But as I mentioned at the beginning, none of that speaks to you. And so you still need to get in front of us. You still need to talk to us. You still need to make sure that, yeah, this is what's going on in my life. My conversations with clients, I talk about this stuff. I talk about it every week. I'm going to talk about it no matter what, whether you want to hear it or not. But what I really care about is what's important to you right now. And so please get in front of us. Please reach out. Please come on in the office and say hello. If you have anything I can do for you, do not hesitate to ask, okay? Everybody have a great night.